Let's bring in Jonathan Chaplin, managing partner at New Street Research. Then we're going to trade it here in studio with our own Tom White. Jonathan, AT&T numbers definitely rewarded by Wall Street this morning. Tell us why.
I don't think it was actually the numbers that were rewarded by Wall Street today. The numbers were pretty soft, pretty much in every one of their segments. What the market's rewarding them for today is what they said about next year and the three-year plan. And there they had a lot to announce. It was really big news, actually. So there's sort of three different categories in which they put out guidance. Around operations, they're looking at 1 to 2% top line growth consistently for the next 3 years, 200 basis points of margin expansion, and EPS next year and 3 years out that's well ahead of where the street was expecting EPS to be. On corporate governance, they gave a lot there as well. They've announced 2 new members to the board. They're splitting the chairman and CEO roles. Basically, a lot of the things that were on Elliot's list of things for them to focus on. And then finally, on capital allocation, I think this is probably where the market is most excited. They've committed to basically $30 billion of share repurchases over the next 3 years, retiring 10% of the, or rather driving 10% earnings growth over the next 3 years, just with share count reduction. And in addition to that, taking leverage down to between 2 and 2.25 times. Between those two elements, effectively, retiring all of the debt they took on to do the Time Warner acquisition and 70% of the share count they issued for that deal. They've also committed to doing no big acquisitions over the course of the next 3 years, which I think is something that the market is pleased to hear. And also importantly, looking at their asset portfolio for continued divestitures, including potentially thinking about divesting DirecTV. So that was a lot to deliver all in one go on the earnings call, and not coincidentally, all of those items were on the list of things that Elliott was pushing for.
Right. So definitely a lot of appeasing for the active management involved in the company. When we think about the big picture, Jonathan, obviously the declining numbers on an annual basis are still there. The customers leaving TV on the back of what we saw from Verizon that had really good phone numbers. AT&T's traditional legacy business still ailing a bit. Does that require an analyst on AT&T to sort of be a bond analyst too and watch what happens with yields? Because if that bond market becomes less favorable to AT&T's debt, does the need to push through progress become more imminent? Does it become more pressure?
So I think the equity story for AT&T is linked to the bond markets, because in many ways AT&T is a bond proxy, and so for years that's been the case. But in terms of the leverage position that they're in, what they're guiding to is improvement in operations that'll drive EBITDA growth and a reduction in the overall balance sheet that should make the debt load a lot more palatable. What equity holders and analysts really need to be focused on, though, is how deliverable those targets are in terms of revenue growth and cost reductions. What I would like to have them focus on a lot more today is why they aren't actually delivering a lot more growth on their wireless platform, given how much spectrum they've just deployed, given the fact that they now believe they've got the best network out there. Why is churn still 10 basis points higher than Verizon? What I would have actually liked to hear more from was how they would expect that churn profile to improve and subscriber growth to accelerate over the course of the next couple of years. That's actually where I see the biggest opportunity at AT&T. And with that, there should be an opportunity for margin expansion, just as revenues grow in the wireless business. But the other area where they fall short relative to Verizon is on margins. From a starting point from today's starting point, margins are several hundred basis points lower than they should be when you look at where Verizon's margins are. And so the 200 basis points of margin expansion that they've guided to, actually in the context of where margins could be for this business, I think is conservative. So that's where I think investors ought to be focused over in terms of the guidance that they put out. And the biggest disconnect is results in wireless weren't that great this quarter. They put out guidance that I think is very exciting. And so bridging the gap between where things are today and where they hope to be over the course of the next couple of years is where all the work's got to be done. If they hit their guidance over the course of the next 3 years, this is a $60 stock. That's a huge amount of upside on a mega cap company. The question is, can they get to the EPS guidance in 2022 that they've set out?
I see. Jonathan, real quick before we let you go here, really like this take on the overall growth trajectory. Curious just to come back real quickly. I mean, the stock bottomed out right before the Fed went on its cutting spree. If rates don't go lower from here, does it present a problem for AT&T? Have people been going to it for the dividend? Have they been going to it as a rate play?
Yes, they have. It's the AT&T and Verizon, for that matter, as bond proxies, have been big drivers of the stock from here. If rates don't go lower, it's up for AT&T to deliver on the operating performance that they've laid out. They're trading at about a 10 times PE multiple at the moment. Verizon's trading at 12.5. If they can get Verizon's multiple on their guidance for 2022, that gets you to $60 in stock value. Yeah. So you don't need further rate reductions for AT&T to be a great stock. You just need them to be treated the same way that the market treats Verizon, and for them to get to their EPS guidance. And so it really comes down to what they can do on the operating front, more than rates going lower from here.
Great stuff, Jonathan Chaplin. Really thorough, really nice argument here for AT&T. Jonathan Chaplin, managing partner at New Street Research. Let's bring in Tom White here and let's trade it. Okay, it's at the high year to date. Yeah. Okay, but still you've got some maybe rate kind of questions. Jonathan's point here, look, if it gets the price that Verizon does by the market, there's still a ways to go. How do you think about this from kind of like a neutral strategy?
Yeah, neutral just because the earnings are out. So the news is out, the stock's up. It's up 35% year to date. Maybe it's going to start stabilizing a little bit, just like Verizon did after their earnings. So what I looked at was a simple, basically neutral strategy going out to November, about 18 days to expiration, really short term, Oliver. Okay. And what I created was a short iron condor, collect some premium, collect time decay on this. And what I looked at was a November 36, 38.40 iron condor. So I have a same common strike where I'm selling the 38 strike on the call and put, and then I'm protecting it on the downside and the upside by buying the 36 puts, buying the 40 calls, collecting about $1.20 credit. You can actually collect a little bit more because the stock's up above 38.60 at this point. But you've got these break evens about 36.80 on the downside and 39.20 on the upside. What this takes advantage of is volatility continue to lower after earnings, which it's going to, and then time decay or positive theta in this regard, where the price of this spread contracts on a daily basis. But you do need it to remain between those two break evens by expiration. And the whole idea is to buy that back a little bit cheaper, maybe about 50 cents, 40 cents as you get closer to expiration, because that's when the value will really come out of it. But you need it range bound.
All right, so looking at it post-earnings, capturing some of that right now, keeping it between 37 roughly and 39.
Yeah, all right. Basically.
All right, Tom White, nice work here. Our contributor on the network, giving us the options rundown.